But what I was specifically looking for are very low risk companies. That's attribute number one. These are typically, for those who know our risk rating system, lower the number, lower the risk. These are around 5 or 6, most of them, as I'll be mentioning. But then the other thing I was looking for are companies that are smaller. Not great big companies like Apple, Amazon, Disney. By the way, all three of those companies are down 20% in the last 3 months, in excess of 20%. So if you're wondering, how bad have things been, that's pretty bad for the market. If you're thinking this is just going to continue, I doubt it. So these are not the Apples, Amazons, and Disneys, because those are companies with very large market capitalizations, usually 12 figures, $100 billion plus. I'm looking at companies that are more in the $1 to $5 billion range. And why do I like these companies right now? These are the stocks that tend to bounce back stronger. Usually they snap back higher because they've taken a bigger hit than the big companies usually. They're more volatile, they're smaller, but since I'm really not even thinking about bounce backs, I'm thinking about 3+ years. I like these stocks anyway, and so I think they have, as lighter weight companies, they have an opportunity to go higher than some of those other companies I just mentioned. So those are the two attributes. Again, lower risk companies that are smaller. And here come my 5 in no particular order. For each of these, I'll be mentioning a general investing principle that underlies this pick as well, but I'm going to talk about a few things I like about the company, and then I'll add one note of caution for each of these as well, just to round things out. So, first up this week is Carter's. Now, you may know Carter's. Maybe you know their Oshkosh B'gosh. I think I said that right, brand. I certainly see it in the stores. This is a company that's been around for decades and is really a leader in something that's never going to change. That is cute clothes for babies, for little kids, for toddlers. So this is a branded long-term leader in the space, but also a company that is experiencing rapid growth in e-commerce because you can go and buy clothes directly from them online. So they're participating there. They're not threatened by e-commerce. They are part of the revolution. They're also expanding internationally. So here decades after their founding, they're just starting to make real incursions into China. And you probably know China has babies. That happens in China. There are a lot of babies. In fact, it's nice to know that if you're a Chinese citizen today, you can actually have more than one child for the first time in quite a while, which is very promising. Anyway, so Carter's, this is the business. Perhaps you're a customer, but a company with share buybacks, dividends, and just an impressive company overall. Let me mention, this company has a risk rating of 5. And the stock was recently, when I did this podcast, at about $86 a share. This is a company worth about $4.5 billion today. I want to mention for each of these how I've done with the pick so far. You might be interested. So we first picked this in Motley Fool Stock Advisor in April of 2014. So here we are just about 2 years later. The stock's up 18%. Not bad. Hasn't lit the world on fire, but the S&P 500 by comparison is up 3%. So this company is beating the market by about 15 percentage points so far, and I like it a lot for the long term. One note of caution for each of these. For this one, the strong dollar, which is true today, the American dollar has appreciated dramatically against many worldwide currencies. The U.S. economy kind of a safe haven, and that hurts companies like, in this case, Carter's, when they're trying to sell their produce abroad. So their manufactured goods, in this case, their apparel, their threads, just have a higher price tag if you're looking at them in China today than they would have a few years ago. So that dampens some of their international growth possibilities in the near term, but this is a cautionary note that is not a long-term cautionary note. It's just something about the here and now. And then my closing general investing principle that Carter's, I think, highlights for us as investors. I love businesses that deliver over decades, that please consumers, particularly companies that can create consumer brands over multiple generations. That's not easy to do. And further, this is a lesser-known company. You probably were expecting me to lead off Rule Breaker Investing with my, favorite tech stock, whatever that phrase means, by the way. But my favorite tech stock, no. Actually, I'm leading off with Carter's. And one thing I like about Carter's is it is lesser known. It's not something you'd expect maybe from Rule Breaker Investing or for your friend at the water cooler to be talking about. But these are the kinds of companies that really do return well for us as investors over long periods of time.
As always, people on this program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Learn more about rule breaker investing at rbi.fool.com.